Welcome to the first lecture on the conceptual framework for financial reporting. The conceptual framework is an incredibly important document. It lays out the foundation for the rest of the accounting standards and should be your basis for your whole accounting thought. So the first little section we're going to do is we're going to look at what is the framework. Now, the framework sets out the objectives and concepts that underlie the preparation and presentation of general purpose financial statements for external users. That's very important. General purpose financial statements for external users, not management accounts for internal users at all. So the framework provides a theoretical background or general frame of reference that's primarily used by the standard setters when setting new standards. Just remember that the framework is not an accounting standard. It's not an international accounting standard. It's not an international financial reporting standard. It's not an IFRIC. It is the framework. It does not override any of the IASs, the international accounting standards, or the IFRSs, the accounting standards. The purpose of the framework is to assist standard setters and the standard setter that we'll be dealing with in IFRS is the International Accounting Standards Board, IASB, based in London. It's also to assist the preparers of financial statements, so that's the accountant, the financial director, sitting at a company preparing the financial statements. Who comes along after that? Well, the auditors. So the framework also assists the auditors in their assurance engagements. When they come and say, yes, those financial statements do fairly present, they have to understand what is the framework on which the general purpose financial statements are prepared. There are also other users, and those other users could be anyone from the general government, the tax authorities, the Reserve Bank, labor unions, employees, suppliers, when they're looking at doing business with you, etc. Now, the framework has been, originally the IASB had a framework that it drew up in 1989. Now, that framework is not as relevant for today's users as it was back then. So what's happened is that the IASB, in conjunction with the FASB, its American counterpart, are jointly developing an improved conceptual framework that will be more relevant to today and will address a lot of the underlying issues that there's a lot of political debate about. So the 1989 framework is being replaced. Now, it's not currently fully replaced, but it is being replaced in 8 phases. The first phase, namely the objectives and the qualitative characteristics, well, that has been completed, and that was fully effective from 2010. So we'll call that the 2010 framework. The definition of elements, recognition criteria, and derecognition, well, that is still active. Remember, elements here, when I'm saying elements and element definitions, I'm talking about assets, liabilities, equity on the statement of financial position, and income and expenses for the financial performance side. The measurement phase, phase C, is also still active, and that's probably where the biggest amount of political debates happening. In the 1989 framework, all that the IASB did was list a couple of the measurement bases which are currently used. Now, what we get a feel that the underlying arguments are about are between two camps, the historical cost camp and the fair value camp in the standard setting bodies. Now, they fight over everything, and what happens is there's standards that are being set that are either very fair value focused or very historical cost focused, but the problem comes in, we haven't yet figured out what is the underlying measurement basis in terms of the framework. There's a new concept as well in phase D. The reporting entity concept is looking to be defined, and that has not yet been completed. That's still active. Also, boundaries of financial reporting and then presentation and disclosure are part of phase E. Phase F to H are the not so important ones: the purpose and status of the framework. Application to not-for-profit entities is phase G, and then any remaining issues will be discussed as part of phase H. So just to kind of lead into the next lecture, we must remember that the framework starts off with the objective of general purpose financial statements. From the objective, we can look at what are the qualitative characteristics Now, those qualitative characteristics are based on what qualities would make information useful. From the qualitative characteristics, we discuss the definition of elements. And definition of elements, as I said earlier, that is your assets, liabilities, equity, income, and expenses. Now, definition, if something meets the definition of an asset, it still needs to meet the recognition criteria in order to be recognized in the financial statements. So the next part of the discussion would be focused on what are the recognition criteria, and we also discuss the underlying assumptions for general purpose financial reporting. That's going to be your accrual basis of accounting and your going concern concept. And the last item to discuss is your concept of capital maintenance. Now, all of these will have their own little printable video, and the most important thing is to get your objective, get an understanding of that. What's going to be very important for your day-to-day practice, however, is the definition of elements of assets and liabilities and the related recognition criteria. Thank you.